Hi, everybody. Today's income investing idea is Digital Realty Trust, ticker symbol DLR. One of the largest REITs in the world, Digital Realty is a real estate company that specializes in data center properties. If you're not familiar with what a data center is, think of this as the physical homes of the internet. Every time you're accessing a cloud based application or looking at a video that's stored online, like you are right now, or uploading something to your social media, all that data has to physically live somewhere, and that's where data centers come in. Digital Realty owns 290 data centers worldwide, leases space to about 4,000 customers. Its customer list reads like a who's who of major tech companies. Top tenants include companies like IBM, Facebook, and JP Morgan Chase. A lot of financial companies use these. So it has a footprint worldwide. Most of its revenue comes from the US and Europe. About 85% right now comes from those two regions. And unlike a lot of other data center operators, Digital Realty owns most of its properties. A lot of its competitors, especially the largest one in the world, Equinix, they use kind of a subleasing model in a way. It's a common practice in the data center space to lease a frame of a building, build out the data infrastructure, and sublease space to tenants. So Digital Realty is more of an owner than most of its competitors. It is one of the, I mentioned it's one of the largest REITs in the world. It's got about a $36 billion market cap. It pays a 3.9% dividend yield. It has increased the payment. And here's where it's nice for income investors. It's increased the payment every year since its 2004 IPO at an average annualized rate of almost 10%. So, in other words, you're getting an income stream and you've gotten a 10% raise every year. That'll more than help you keep up with inflation. That's why this is a really nice one to put on your radar. So there are good and bad qualities to this, just like every other stock. There's pros and cons to consider. The pros is that, well, one of the biggest advantages of investing in data centers is that there's a lot of room to grow. If I'm just looking around my room and I have 10 different internet connected devices in this one room, whereas a decade ago there might have been one or two. So the world is becoming a much more connected place. Data is becoming more sophisticated running around the world. Think of the 5G rollout, for example. It enables a lot more data to flow around the world. All that data needs a place to live. And a lot of the new technologies being developed, like autonomous vehicles, augmented reality, artificial intelligence, are all very data heavy. So there's a lot of long tailed catalysts for this. Digital Realty grows and delivers returns for shareholders in a few different ways. This is how it's delivered such market beating returns over time. It develops properties from the ground up. Most of its recent purchases have been land in foreign markets that it eventually plans to build data centers on. So it buys the land, builds data centers from the ground up, and then leases them out. It grows a lot through acquisitions. It's made a few major acquisitions in the past few years, acquiring two major competitors since 2017. It acquired DuPont Fabros in 2017 for 7.6 billion and a company called Intersection in 2019 for 8.4 billion. So it grows through major value adding acquisitions as well. And all of its leases have gradual income or rent increases built right in, average about between 2 and 4% per year, depending on the lease. It has a very strong balance sheet. Most of its debt is fixed rate. Most real estate companies use quite a bit of debt, so don't let that scare you off. Its average interest rate it pays on its debt is just 2.2%. It would be nice if my debt was that low. And it has it has investment grade credit ratings, so it has a lot of financial flexibility to continue to grow. It's got a lot of opportunities internationally. I mentioned U.S. and Europe account for eight. It's actually 87% of Digital Realty's revenue. They've recently started joint ventures in places like India, which currently accounts for less than 1% of its revenue. A joint venture in Israel. It recently expanded into the Africa data center market, which is a very underserved and very high potential market. So a lot of international expansion, even though it's one of the largest REITs in the world, it still has a lot of room to grow. I can see this growing to several times its current size over the next decade or so. And it's also a very sticky type of business. Its customers spend a lot of money when they move into a data center. A data center is a secure place to house servers and networking equipment and stuff like that. So it requires a lot of investment on their customers' part. And switching data centers, it has a lot of switching costs, and it's a pain to do. So they have a very high customer retention rate for that reason. On the downside, there are a lot of experts, including some that I respect very highly, that are very negative on the data center real estate space right now. Jim Chanos is the big one. He is the probably the most famous short seller in the world. He recently issued a report saying that, quote, data center REITs are his big short right now. A few different reasons. He says the way to make money off the cloud surge is through the cloud providers themselves, not necessarily the data center operators. A rising rate environment could be bad for data centers, which is true. Their borrowing costs could go up a little bit. And a lot of it is that he views the the tech companies as competitors to the data centers, not as partners, which is the part of the thesis I think he's wrong about. The tech companies don't want to bring their data center needs in-house. He he essentially thinks that they're going to start building out their own facilities, and I just don't see that happening. It's a very capital intensive practice. A lot of the big tech companies have their own data centers. Apple owns a bunch of its buildings, for example. But I don't see that happening on a large scale to the point where it would really affect the long-term data center thesis. Um, as Digital Realty CEO Bill Stein really said that demand has never been stronger than it is right now in the space. And he thinks that the cloud service companies are its partners, not its competitors. And it really has formed a lot of partnerships with a lot of the big tech companies over the years. And I don't really see that changing. Beyond the short thesis, there's always oversupply risk when you have a market with a long potential demand in the future, kind of like data centers have right now. So there's always the risk that they could overbuild and have too much capacity for the demand. There's exchange rate risk. Um, if Digital Realty has a data center in a foreign market, it usually gets paid in the local currency. I mentioned a lot of its revenue comes from Europe. And just to name that example, the dollar has increased in value by 13% against the euro over the past year. So that kind of hurts them in the foreign exchange category. And REITs in general get put under pressure a lot when interest rates rise. We're seeing this now. It's one of the reasons we're seeing pressure on the real estate sector right now, even though the underlying businesses are doing quite well. Interest rates are rising. It means you can get more from risk-free investments, such as like a 10-year treasury bond. When you can get more from risk-free investments, investors expect more of a risk premium from their riskier investments like Digital Realty and other real estate companies. And since price and yield have an inverse relationship, you see higher yields put pressure on real estate investment trust prices. So, things to keep in mind, we could definitely see this under pressure, especially if inflation and interest rates become more of an issue than they are right now. But this is still a very solid income investment with a lot of long term growth catalysts and a lot of international growth potential. And it's one that's been in my portfolio for about 10 years now, and I've incrementally added over time. And it's one that if you're an income investor and you want to see a growing stream of income over time, this one has a pretty good track record of doing just that. This video is sponsored by the Motley Fool. Check out the link in the description to receive the top 10 best stocks to buy now or visit fool.com/Frankel.